Hi everyone, thank you for joining us for today's webinar. We're going to give it just another minute for some people to log on before we get started. Hi everyone, and thank you for joining us for the Q3 2023 Mortgage Trend Series. This quarter's presentation will be focused on managing liquidity in addition to the financial benchmarking and performance trends from our recently published Q2 data. In case you are not familiar with Richie May was founded in 1985 and has been focused on serving the mortgage industry ever since. We offer accounting, audit, tax, compliance, technology, consulting types of services to the industry. With around 300 clients nationally, we can see a lot, and our goal is to leverage what we learn from working with those clients and what we see in that data to really provide value back to you all. Before we get started, we have just a few more housekeeping items to cover. I know there's still quite a few of you joining us, so this will give you a little bit more time to get fully logged in. Molly, do you want to flip our slides a little bit? So give us 1 second to make sure our slides are matching up to our content. Hold on. Okay, sorry about that. We had a little bit of a technical difficulty, but our slides should now be moving and you should all be able to see them. If you're having any trouble viewing them, please let us know, but no worries. We're moving right along now. All right, so housekeeping items. All participants will be placed on mute during the presentation, but during the Q&A session at the end, feel free to unmute yourself to ask any questions. You can also submit questions into the questions box at any time throughout the presentation, and we'll try to make sure we answer anything that's submitted. If we don't get to your question though, don't worry, we'll have one of our experts reach out to you afterwards. If you're looking to get CPE credit by attending this live event, you must answer all 3 poll questions that are scattered throughout the presentation. We're gonna have our first one here in a few minutes. So make sure if that's something you're looking to do that you get logged in and get ready to answer those questions. If you answer all those questions and you earn the credit, the certificate will be emailed to you within a couple of weeks. And yes, we will be recording this presentation, and both the slide deck and the recording will be sent out to you in the next couple of business days. And with that, I want to introduce our presenters for today. We have Molly Manuzak, who is the director of our business intelligence and analytics practice. And we have Seth Sprague, who is the director of consulting services here. Without any further ado, I'm going to hand it over to Molly to get started.
Okay, thanks so much, Gabby. So thank you for the introduction. And for those of you who might not be familiar with my team and what we're responsible for several analytic and benchmarking offerings with Richie May, which includes Richie May Select, which is most of what I'll be focusing on today. So Select is a quarterly financial benchmarking program that we've been doing for well over a decade now. Each quarter, participants, so who are mostly IMBs, submit their quarterly financials, and then they're able to see that data in comparison to their peers. Peer groups are broken out by size and channel mix, and today what I'm going to be doing is reviewing results from the entire population. So I'll be reviewing results from Q2 of this year, including origination trends and key financial metrics. So in Q2, we did see an overall increase in production, and we also saw an increase in both net production income and GAAP net income, and I'll go over the differences later. Average loans closed per FTE or per employee were up in Q2. And then finally, we did see a decrease in costs to originate on a per loan basis this past quarter. Again, we're looking at Q2 results for the entire Select population. So just keep in mind we have companies of all channel mixes, sizes, etc. So we really want to focus on trends here or movement and averages over time. But this quarter, I'm also going to be diving into some key differentiators that we saw in top performers compared to other participants. And then I'll also be looking at some origination trends, some more recent origination trends from our peer benchmarking in Analyze. So before I dive into origination trends, we're going to do a quick poll question. And as a reminder, if you're looking to get CPE credit, you do have to answer all three of these. So the poll question is, what is your expectation of mortgage originations in Q3 2023 compared to Q2? Do you expect originations to be up between 0 and 10%, flat to Q2, down between 0 and 10%, other, or I don't originate? So we'll go ahead and give everybody a little bit to answer.
We'll go ahead and give it a few more seconds. I can still see that we're waiting on some votes. I know we've said this a few times already, but please make sure that if you want the CPE credit, you get your vote in now for this question. It doesn't matter how you answer. All right, we're going to go ahead and close the poll.
Okay, great. So it looks like the majority of people who answered expect originations to be down between 0 and 10%, and then a good amount saying flat to Q2. So that's great feedback. I'll go ahead and dive into what we saw in Q2 as well as what we're seeing this quarter so far. So here we're looking at origination volume or average production over time, going back to early 2018. In Q2, production was actually up compared to Q1 of this year. On average, participants saw an increase of about 46% in Q2. However, when we go back to Q2 of last year, production volume is still down about 40% from the same quarter last year. And then if we look at the purchase versus refi mix, purchase production did increase again this quarter, up to 92% of total volume, which is the new high watermark in our program's history. But I'd say this is very consistent with expectations given the current rate environment and recent increases we've seen. Another thing to note is that government production has also been increasing as a part of overall production over recent quarters. In Q2, government production was up to 36% of overall production, which was a 10% increase from Q1 of 2023. And another thing to note is we haven't seen levels that high since 2017. So definitely, a shift there. So here we're looking at production numbers from Q2, which were released for the prior quarter last week. However, now we're just over halfway through Q3, so I'd like to discuss some more recent trends, and we can do that through our peer benchmarking from Analyze. So that's through PeerView Ops, which allows our clients on Analyze to see how they're performing in key production areas compared to their peers. And since this data is updated nightly, I can actually see current Q3 results compared to that same point in the prior quarter. And kind of similar to what we saw in that poll question, funded production is down quarter to date on average, but currently only about 5% in terms of volume and about the same in terms of units. So definitely down this quarter, but only about 5% right now. I also looked at total applications and locks to get an idea of where production might move throughout the rest of the quarter. Applications are also down quarter to date, a bit more than funded production. Apps are down about 15% in terms of volume, but locks are nearly flat or down marginally, just about 2% at this point in the quarter compared to Q2. So definitely the expectation is that Q3 volume will be down, although currently, again, funded production is only down about 5% compared to the same quarter last year when looking at our peer benchmarking in Analyze. So now I'm going to move into some of the financial trends that we saw in Q2 from Select, from that financial benchmarking. So here we're looking at net income versus net production income. Net income is that GAAP net income or that audited income statement, whereas net production income is really intended to show origination platform profitability. So this quarter, we did see an increase in both GAAP net income and net production income. When we look at net income, that did increase on average, which led to an overall net gain in Q2. So net income was up 92 basis points compared to Q1, leading to a positive gain of 5.3 basis points on average. Another note is that about half or 50% of participants this quarter had positive overall net income, which is up pretty significantly from Q1, where only about 20% of participants had positive net income. In Q2, that increase was mainly driven by decreases in total expenses. Notably, we saw salaries, commissions, and benefits decline by about 20% in Q2. And then we did actually see a decrease in revenue in Q2, but that was offset by the larger decline in expenses, again leading to that overall positive net income. So now I'm going to dive into some of that top performer data. So what we did for this comparison is we looked at the 20% of participants in terms of GAAP net income and compared that to other participants in the program. So again, revenue was down in Q2 across participants when looking at net income. However, when we compare the two populations, there was a difference of about 50 basis points from the top performers, a positive difference compared to other participants when looking at gain on sale. Another major differentiator was in expenses, but again, related to salaries and commissions. That was about 45 basis points lower. And really those two factors combined push net income for top performers into that category and really differentiated them from other participants in Select. And so net production income, we're going to go ahead and switch over to that. And just as a reminder of kind of how that differs from GAAP net income, again, this number is intended to show origination platform profitability. So we're excluding a number of different items to give a more apples to apples comparison. So we're taking out any items not related to production, so anything related to servicing, so servicing income, expenses, or adjustments. And then we're also removing any outside activity or investments. We're also trying to minimize noise from unrealized gains and losses over the quarter. So we're removing the unrealized gains from your unfunded block pipeline. That's taken out of the secondary gain on sale number, and then removing any loan loss reserves. So net production income was also up in Q2, about 76 basis points on average. However, net production income was still negative overall in Q2. We saw on average it was negative 33.8 basis points, and net production income are the green bars on your screen. So the overall increase in MPI was really driven by similar factors. So overall production increases and then continued decreases in cost to originate. However, for net production income, the improvements there did not fully offset the drop in secondary margins, which led to an overall net loss on production profitability this past quarter. A couple notes about the changes that we saw in that report is that we did see a decrease in net warehouse spread, and that spread was actually negative in Q2. So that net warehouse spread is going to show the difference between interest income on loans held for sale and then interest expense and warehouse fees. That typically is a positive number. It's not really a large contributor to overall revenue, but it really does demonstrate the continued challenges that lenders are facing right now in the industry. So I'm going to talk a little bit more about that top performer population compared to the rest of participants. So we did really notice very similar trends here for net production income that we saw in net income. And I'll note that we're still looking at that same population of top performers here. So participants whose overall profitability was in the top 20%. Similar to GAAP net income, we did see increased revenue with top performers, but I'm really going to focus on the overall decreases that we saw in expenses compared to that bucket of other participants. So overall for top performers, expenses were lower, but especially on the sales personnel side, looking at sales and sales support. So sales personnel expense was lower in Q2 for top performers by about 30 basis points on average. And I'm going to talk about this a little bit later as well. But the interesting thing is that expenses were down for sales personnel, and top performers also outpaced other participants in terms of efficiency metrics like loans closed per employee. And then outside of personnel, top performers did have lower overall operational expenses by about 10 basis points. So not as large of a gap, but still noticeable. We also noticed that for top performers, the purchase versus refi mix did skew heavier towards purchase with a very little refi production. So only about 3% of overall production was refinance for those top performers. And this might contribute towards the lower advertising and marketing expense that we saw for that top performer population. So they're just not spending as much of those marketing and advertising dollars there. An area that we did see slightly higher expenses for in top performers was in professional fees related to third parties, which really just shows that some costs are worth incurring to stay competitive and kind of be in that population. So now I'm going to dive a little bit into secondary gain on sale. And this is coming from our net production income report. So we're really trying to show realized gains and losses here. That does play a large role in that overall NPI number. So again, we're looking at all participants on this slide. So an average of all participants over time. Again, there's lenders of all shapes and sizes here. But we did see a decrease in that secondary gain on sale. It was down about 12% in Q2 compared to Q1, or about 34 basis points. In Q2, that secondary gain on sale was 255 basis points. So again, we're just showing realized gains here. So removing any sort of unrealized gains or losses on those unclosed interest rate lock commitments or open hedges. The last 2 quarters, so Q4 and then Q1 of this year, we saw increases in secondary gain on sale, but the decrease this quarter really brings margins more in line with that historical low that we saw in Q3 of last year. Overall, gross loan margin revenue was down due to this drop, but we did see some increases in loan origination fees. It just, wasn't nearly enough to offset the drop in secondary gain on sale. So now we'll look at an efficiency metric here. So here we're looking at average loans or average closed loans per employee each month. So to get to this number, we're taking total closed loans over the period and dividing that by total headcount, then converting to a monthly average. So on average in Q2, we did see a pretty significant increase of about 43%. Loans closed per employee per month was up to 1.3. So really that's due to increases in production coupled with the downsizing that we've seen over the last 5 quarters. Total headcount was also down in Q2, but overall personnel in total was down only about 3% on average compared to Q1. So still decreases there, but not, more of a lower magnitude. So looking at staffing levels now, we're back down to levels seen in 2019, but really the composition of overall employees has shifted slightly to a little bit more sales and corporate personnel and less on the fulfillment side. That likely stems from efficiencies gained and investments in technology since 2019, so in the past few years. So I'm going to dive a bit more into that top performer population. So again, loans closed per employee was up in Q2, and then we did see an increase in that number for top performers compared to other participants. So on average, that was about 45% higher for top performers compared to everybody else. And that really stands out when looking at sales personnel. So the number of loans closed per sales personnel for top performers was about 2.5x that of all other participants. And then really that held true for producing sales staff, so LOs, AEs, etc. But when we look at support staff, the number was a lot higher. So loans closed per individual under sales support staff was 72 loans per month per employee for top performers, which was actually 4 times the amount of what we saw for the other participants. So a pretty big jump there. And then if we recall that cost per loan was down significantly more for the top performers, that just really shows the efficiencies that these lenders have captured, in order to have these higher efficiency metrics. So the last thing I'm going to talk about here is cost to originate. So we're looking at total cost to originate on a dollars per loan basis. So looking at all expenses related to originations, which would exclude anything related to servicing or any outside investments, and then dividing that by closed loans over the period. And so for the first time since Q2 of 2020, we did actually see a decrease in cost to originate on a per loan basis. So that cost was down about $3,200 compared to Q1, or down about 22%. And so cost to originate on a per loan basis was down to $11,184. So again, that is the first decrease we have seen after 3 years of consecutive increases. And that decrease in cost was really driven by those continued cost saving measures and increased seasonal production. So costs were down across all departments and expense groupings. And as discussed earlier, we did see an overall reduction in headcount for the 5th quarter in a row. So in personnel expenses, we saw, again, decreases across departments on a per loan basis. So sales was down 7%, fulfillment roles, 25% decrease, and then we saw a 32% decrease on average for back office. And then ops and overhead expenses were down as well in Q2 compared to Q1, down about 31%. And then we did actually see a pretty material decrease in a couple of categories. So in rent and occupancy, and then general and administrative expenses. So in Q2, we certainly did see some improvements compared to the prior few quarters, particularly to Q1. In Q3, we have continued to see volatility in rates and overall increases, which is certainly impacting production. Looking at Freddie Mac's most recent rate survey, they showed another increase. That's certainly what we're hearing with our clients. So we do expect continued uncertainty throughout this year and possibly into next year. But I will say the trends in Q2 that we saw are highlighting the positive impacts of the cost-cutting measures and efficiencies gained by lenders this year and last. So I think that really is kind of a bright thing to look at. So thanks everybody for your time. I'll go ahead and pass things over to Seth.
Thanks, Molly. As always, great information, and thanks again for all that comparison data. I'll just highlight a couple of things that Molly had talked about. Just remember that Q3 2022 is kind of the last good quarter. So like once we start comparing ourselves to Q4 of 2022, things might start looking a little bit better on those year-over-year comparisons. But also to Molly's point that she had brought up on the FTE side, just coming off of Western Secondary and obviously talking to a lot of folks, sadly to say, but there's obviously another round of job cuts that most people either have executed in the last 30 days or are planning to execute in the next 30 days. As Molly pointed out, rates have come back mid-sevens-ish as mortgage rates. And so, sadly, there's another round of cuts coming. You can see that those cuts are having a real impact on all that data Molly presented. But sadly, it looks like we're going to be staffing even thinner here going forward. So I'm going to talk about managing liquidity. But before I think we go there, I think we've got a poll question, if I'm correct, in the order here. So why don't we pull up the next poll question? Remember that you got to answer all 3 of these to get the CPE credit. So we were just doing a quick poll, the folks on the call, see if they're going to attend MBA Annual in Philadelphia in October. So this is a pretty easy one. Yes, no. Still deciding likely yes, or still deciding but likely no. Obviously, it's on the East Coast, so some of the folks on the West Coast, this may be a little bit more of a challenge for them to get there. But we're just seeing if, thought it'd be a quick poll just to see off of this what people's thoughts were around attending in Philadelphia. So Gabby, you tell me when we start getting to critical mass, and then we can move on to the liquidity traps or challenges.
Like we still have a few more rolling in here.
They're still deciding, and this by checking here, you're not getting a bill from the MBA. It's just a survey question. So, you can type yes and still not register. We're just trying to do a quick thought would be an interesting just survey poll of folks.
Might be a few of you still trying to go for CPE who haven't answered, so make sure you get that poll question answered in the next couple of seconds.
We thought this would be an easy one, a quick one.
You're good. I'll go ahead and close this out.
All right, let's see what we got. Well, that tells me I'm just not going to go to Philadelphia if these are the results that people aren't going. So that's fairly overwhelming. I will say that I do think attendance in Philadelphia may be a little bit off from previous annuals. But hopefully people can find it. There's a lot of stuff going on in the industry, and I'm going to talk about some of that now. And obviously the MBA is doing a lot on the liquidity challenges that are faced. So Mal, if we roll to the next slide, we'll start here. And we're going to go through these slides pretty quickly. This is just a quick refresher for folks because we've been in such an inverted yield curve for such a long period of time, but this is a normal yield curve, positively sloped. Rates at the low end are lower than rates at the high end. If we go to the next slide, and it's in bunny years, so normal is never really normal. This is the yield curve as of July, and it might even be more sort of kinked today, but this is not normal, right? The Fed has moved rates on the short end of the curve, and the long end of the curve is telling us something different. And depending on where you're valuing escrows, depending on where you're doing things, this has a lot of implications. But more importantly, for a couple things, we go to the next slide, for banks and for IMBs, as Molly pointed out earlier in her part of the presentation, warehouse spread is negative per the Richie May data. And Molly, if you go next slide, and this is a function of a couple of things, right? It's a function of the warehouse lenders, tying their rates to the short end of the curve, which keeps coming up, SOFR or something equivalent on the short end of the curve, and that spread between the short end of the curve or your borrowing costs and mortgage rates has compressed. And it continues to compress. Though at 7.5%, it might be a little bit better. But so warehouse spread, as Molly pointed out, is actually negative. And that's just, that just means that you just need to be more operationally efficient about getting those loans off. But that is a real impact when you start comparing yourselves to periods where you had more of a normal yield curve. I say this in all defense of everyone doing secondary marketing. They're not doing something wrong typically. It's just that this is a function of it's costing you every day that those loans stay on the warehouse line some money. So again, make sure you're being efficient. Hopefully this changes at some point, but they are negative today. If you're negative, you're in the common boat. And quite frankly, if you are positive, I'm going to say a couple things. You probably may not be you may be under an old rate environment. As people renegotiate or renew these lines, they tend to see that these costs are going up, and we'll talk about that in a little bit more as well. So, Mal, if we go to the next slide, as we think about the challenges on the liquidity front, again, Richie May is highly focused on the IMB market. We also do a lot of consulting work for banks. And let's talk about the bank challenge for a second. That inverted yield curve is a real problem for banks, right? Their cost of deposits is based on the short end of the curve, and then they lend on the long end of the curve. Well, when that's negative, that's a negative spread for them. So that's bad for banks, right? They typically like to pay 1% on your deposits and lend it 4%. That is not what is happening today. In addition, banks are under pressure, right? A lot of money went into banks as a result of stimulus, COVID, and that money is coming out of banks as people are having to pay for goods and services at a higher cost due to inflation. So banks are under tremendous deposit pressure. That leads them to do certain things, right? When they're under deposit pressure, it leads them to think about, well, maybe I shouldn't be loading up on jumbo loans at this point because my deposits to loan ratio doesn't work. Or maybe I should be shedding some mortgage servicing rights because that's a higher risk-weighted asset and it gives me more capital or preserves capital when I sell that. And what we have seen, and sadly we've seen a couple of banks exit the warehouse line business. That is a fairly heavy risk-weighted asset. And remember, banks, much like other folks, have portfolio loans or bonds, mortgage-backed securities, that in essence are underwater to par. So they can't really trade out of those securities either and reset their rates or their earnings there. And so they're under tremendous pressure. It's times like this where we always think about, hey, let's do seconds, let's do HELOCs, let me do more jumbos. These banks will buy the product. Banks' balance sheets are under a lot of capital scrutiny and a lot of pressure these days. And that's why you're seeing their behavior in this cycle. It's a little bit different than what we traditionally have seen. And if we go to the next slide, we'll refocus ourselves now on sort of the IMBs and what non-depositories are facing. But I like to think about this as all sorts of different places where there's liquidity needs for non-banks. And these liquidity needs are often funded by banks. So obviously on the origination side, you need warehouse lines. And as we kind of talked about, yeah, the cost on the warehouse line is going up. There's less people in that space. And I hate to say it, but there's probably going to be even fewer people in that space if these new Basel III endgame capital rules get fully implemented. Okay, so we need it on the origination side. We clearly need it on the correspondent side, right? For those that originate and don't want to put the servicing on their balance sheet or don't have agency tickets, they need a consistent outsource for correspondent to buy whole loans. You know, what's that depth of the buyers? What's the consistency of the buyers? Are you seeing some banks and you seeing some others sort of starting to exit the space a little bit or become more selective in what they want? That's telling you something, right? When an aggregator is saying, hey, that product I used to buy, I don't want to buy anymore, that should be creating those conversations at the board level about why are they making that decision? Is it capital? Is it risk? Is it something else? And it ought to be trying to refocus you all into maybe that's not the product that we should be originating because we need that consistent outlay for it. If folks are retaining servicing, right, they potentially need MSR financing lines. They certainly may need advance lines, right? For those that are holding Ginnie Mae servicing, you're likely making actual out-of-pocket cash advances due to low level of prepayments and fairly high delinquencies on that FHA book in particular, right? What is your cost on your MSR financing lines? It's typically SOFR plus a spread. Well, again, there's only so much yield in that MSR asset, and as that compresses, those financing lines start to look more expensive. In the MSR market, for those that retain servicing and then may want to sell it at some other future point in the bulk market, or even through the co-issue PIT programs, you need to make sure that there's liquidity there in that space. And we'll talk about a little bit of that. And then sadly, and this was a topic that we had covered several months ago, and I know a bunch of folks have been talking a lot about repurchases, but, you know, repurchases are happening. Fannie and Freddie are, you know, there's a 3-year window for them to review loans. So, you know, really, it's really August 23rd, 2020, and earlier that you have sort of this relief at this point, and they still got a 3-year window to go back and look at it. So we've got to get through the rest of 2022, 2020 originations, all of 2021 originations, and 2022 originations before we could kind of say, hey, we're through that repurchase risk. And remember, in the second half of last year, originations fell off. So you still got that kind of 6 quarters or 7 quarters of high volume that they're trying to chunk their way through. So you might need a hospital line, right? You may not be able to sell those in the scratch and dent market. So there's a lot of these little liquidity traps that I think you need to just kind of be constantly thinking about and trying to manage. If we go to the next slide, we'll do a little bit deeper dive here on some of the trends. But you know, one of my mantras has always been make sure you understand those servicing cash flows and what you've retained, right? Do you know when your next round of escrow analyses are being done? Do you have an estimate of what those shortages could be, right? What is your exposure to natural disasters? Sadly, right, there's been several natural disasters recently, right? Most highlighted would be obviously the fire in Hawaii, but we are in full hurricane season at this point, right? Western Secondary dodged a major bullet by that kind of storm, kind of taking a little jog inland instead of staying off the coast. There's a lot of stuff in the Atlantic Ocean going on. Texas has just got sort of hit with a tropical storm. What are your exposures? Do you understand your exposures? Do you understand the new forbearance process when it comes to that? Those are all impacts to you as a servicer. Also, there are impacts to you on the origination side of the business, right? Where all of a sudden somebody can't buy loans in this zip code because it's under a FEMA disaster. So again, liquidity is very important to understand. Understand those servicing cash flows, understand those pitfalls. And if you've executed a sale, how good are you at getting those trailing documents? You know, that 5 or 10% holdback, that's real cash to you. So make sure you're doing a good job in that space. And finally, on the retained servicing front, if you haven't looked at your 2022 originations and their delinquency trends, I would do a deep dive. You may see that your overall trend is increasing, but it's probably dramatic in that book. So really understand the cash flows, really understand the advances requirements, and understand the potential risks hidden in that servicing portfolio. If you go to the next slide, Molly, we're going to talk a little bit about the other traps that are out there, or the motivations of these MSR buyers, right? Understand who the buyers are. And if you're going to go to the MSR market, make sure that you've kind of clearly communicated where you fit within these buyers. And these are buyers I've made up. This isn't coming from the servicing broker firms, but this is just my impression of who's out there, right? You got the duration buyers. They want the low coupon, non-delinquent Fannie Freddie servicing. But what they're looking for is consistent sellers, right? Are you going to give me enough volume so I want to bid your portfolio? There's also buyers out there who are looking for that customer, right? They're looking for something either within a certain geography, certain investor group that they think they could turn into a bank customer or a customer for that entity. There's your refinance buyers, right? Those are the buyers that are more or less buying the servicing for the customer and the ability to refinance that loan should rates fall. And then there's everybody else that I threw in the niche buyers. So if you have a servicing portfolio, it's probably worth spending a few minutes just thinking about, well, where would this fit in within the potential buyers? And does that make sense? Is there enough volume? Am I going to be a consistent seller? Is there enough refinance opportunity? And that will really help you shape what a servicing transaction could look like, or who your potential buyers might be in that space. So it's really understanding the motivation of the buyers, I think, is important if you're approaching that bulk servicing market. And even to some extent, the co-issue and the PIT market as well. If you go to the next slide, Molly, as we think about the risks on the challenges here, it all comes down to modeling those cash flows. Is it going to prepay? Is it going to go to delinquent? How certain are they of those cash flows? And remember, the cost to retain servicing, and there's new liquidity standards that's out there for non-banks that's starting to come into play. There's certainly the new capital rules that are proposed for the banks. So really understanding what structural changes have changed over the last year to FHA MIP, to the ability of borrowers to actually refinance, have those programs gone away. All is important when you're thinking about the liquidity challenges across the MSR portfolio. And obviously that lack of refinance incentive for certain buyers that rely on recapture income to purchase servicing, that's really like those are the people that are hoping rates, we're all hoping rates go down, I think, but those are the ones that are really relying on those rates to go down to have the best bid. So we want to cover that real at the high level on the MSR market. And now we're going to pivot on the next slide to cover a little bit more of these capital rule changes with Basel III Endgame. And in full disclosure, right, let's level set for a second. These are proposed rules at this point. They are not finalized, but we're already seeing some reaction from the industry. MBA really got out in front of this, and you can see there's been a lot of commentary about how managing liquidity, potential liquidity traps, liquidity might go away from the mortgage market, consumer costs might go up. They hit this message even before the rules came out. To summarize, and I mean, there's a lot of stuff you can read out there on this, but summarize it in as few bullets as I can. One, banks over 100 billion of total assets are impacted. So understanding who's providing you financing, where they fall into their total asset size is important. Okay, these are proposed rules. The earliest they would go into effect is July of 2025, and then it'd be a 3-year phase-in period. We're in a comment period till November 30th. Okay, this will, if left as is, cause a couple of things to happen. We're likely to see, and if we go to the next slide, we'll see the banks and their tickers that are impacted. Some of these banks you may be very familiar with. Other of these banks aren't in mortgage banking. When people ask me, Seth, do I think this is going to change the mortgage landscape? I just hit pause for a second and go, look, let's look at who's in category 1 and 2 and think about their presence in the mortgage space today, right? And is Bank of America really in the traditional mortgage space today? And my answer would be no. Is Citicorp really in the traditional mortgage space? My answer is really no. Is Wells Fargo still in that space? Well, they were until they decided to get out of correspondent and have been selling servicing. So JP Morgan Chase. So as you look at those banks that sit there that are the largest, some of them were never in mortgage, full disclosure. Others that were big in mortgage are certainly not as big in mortgage as they were. And then if you go to the banks in category 3 and 4 here, you see a lot of familiar names. You see people that you may have sold servicing to. You have seen people that you may have a correspondent relationship. You may see some companies here where you have they are your sub-servicer and they are providing servicing advance lines and servicing origination warehouse lines. Okay, so I think it's very important to understand that they are under more capital requirements. And while the risk weighting of these assets isn't changing, they need to deploy more capital. When they have to deploy more capital, that means their costs go up. That means they need a higher return. So as you think about where this leads to, it leads to sort of higher costs in your warehouse lines, maybe less people offering you a warehouse line, maybe from a correspondent standpoint. Remember, 5 of the top 10 correspondents in 2022, per the Richie May Humda data that we published on our website, were banks, right? Correspondent channel is really more than nothing than an elegant, tax-effective way to bring in servicing. So if I need less servicing, what am I going to do with my correspondent channel? So I just think it's important that it's not panic time, but it's understanding where you may have liquidity traps. What should you be thinking about? What can you do to prevent that? And so if we go to the next slide, and we'll leave some time here for Q&A, hopefully. Where I think the biggest impacts are, those banks in that category 3 and 4, they are going from 25% MSRs to 10%. Okay, so they now can hold less MSRs. And as I said on a panel yesterday, when you give me a limit of 10%, I roll that back to 8%, and I put my warning at 7%. So they're not even going to get to 10% of MSRs to Tier 1 common equity. They're going to put a stop in well before that. What can that do? What can that lead to? Look, they're looking at capital. They're looking at allocation of capital. And what we really want to make sure is that, they're going to review who they're lending to on both the warehouse side, the MSR advance side. They're going to review their MSR strategy. They may sell servicing. They're going to review that correspondent channel. They're going to review portfolio lending in light of these new LTV rules, right? Their whole dynamic of how they're interacting with borrowers is going to change, right? What I think happens as soon as the environment in DC sort of becomes a little bit more merger friendly, I think you see a lot of those banks in category 3 and 4 merge because they're not getting the benefit anymore of staying smaller than the category 1 and 2 banks. And look, what's already happened? Banks are selling excess MSRs. Banks are selling MSRs. And in some cases, banks are starting to lay off the jumbo originators. So again, if you're an IMB out there and you're focused in on this strategy, remember, you're going to need that outlet for those jumbo loans. Who is it going to be if the banks aren't going to be a buyer? So what should you do? Our final slide here, and then we'll have our final poll question. I would say stay tuned. And I mean, it's shameless plug for the Mortgage Bankers Association, I realize. Stay tuned to the policy work they're doing. I would attend Philly if you can somehow manage it to get the latest updates from both the Capital Markets Committee. Every committee at the Mortgage Bankers Association is working on these capital rules. Engage with your banks, understand their strategy, and keep asking them, right? The people you're talking to may not know that they're going to shut down their warehouse line or they're shut down their correspondent channel. So keep asking them, are you seeing changes? Are you seeing changes in what people are buying through their correspondent channel? Are you seeing all of a sudden what I'll call pricing that doesn't make sense where they're pricing themselves out of the market? That's a warning sign, right? Take those warning signs and make those into actions, right? Most importantly, understand your current liquidity needs for these various scenarios. The various scenario we talked about in the panel I was on yesterday at Western Secondary was rates stay higher through 2023. What are you going to do? Okay. So, and most importantly, ask for help. We've got data here at Richie May. We've got a lot of experience here. There's a lot of ways that I think the team here, across the team at Richie May, can help. you kind of manage those costs, manage liquidity, manage profitability, ask for help. With that, we've got one more polling question for the CPE credits. So for you CPE folks that are hanging on here, we're just asking a really quick question. Hopefully this one won't take you too long, but how many warehouse lines do you have today? And remember, and I'm going to harp a little bit on the warehouse lines when you're asking this question, right? Everyone kind of rolls their eyes when they say, well, I got more capacity than I need in my warehouse lines. I got 3 lines, I'm all 20% utilization. That's great. But remember, at some point, the origination cycle will change, right? And can those warehouse lines be extended? Can they be expanded? Do you have enough? Do you have enough in the right segments, right? Do you have a construction perm line? Do you have, maybe, can you carve out something for non-QM? Can you carve something out for jumbo? So again, you may roll your eyes and say, man, I got more warehouse line capacity, and if one more warehouse line person calls me, I'm going to hang up. But just remember, you want to make sure you've got it in the right segments with the right counterparties that are going to be good long-term partners with you, because that will change with the capital rules. All right, I danced around a little bit. Gabby, how are we doing on our CPE folks? We getting to the right number?
Looks like we might be missing a few. So again, if you are looking for CPE, now's your chance to get that poll question in. Give you like 5 more seconds.
All right. See, when I start talking about capital, I know people are good. There's probably 3 people have concussions now on this call from passing out about the capital rules. But it is important. It is important to sort of understand that liquidity and go from there. So, not surprising that people have obviously more than one warehouse line. Typically speaking, that's pretty standard. Next time, maybe we'll come back and ask how many do you have a year ago. And obviously, we've got people on the call that don't originate, so they don't need a warehouse line, though. I've always thought about getting a warehouse line. I just don't originate mortgages, and no one's decided I'm good enough collateral, I guess, to give me a warehouse line on my own. Okay, with that, we will open it up we've got a couple minutes for Q&A. And it looks like we've got at least one question in. And Molly, I'm going to give you the one here on the FTEs. So you had that great slide, and I think it was slide 11. I don't know if you want to go back to that on FTEs, but the question kind of came from, and we may not have the data right now, so it's something we could go back to. But the question was that kind of across all channels, or did we kind of segregate, high percentage of retail, low percentage of retail? And we may have to circle back with them, but I guess the question was that the easier question was that across all channels?
Yeah, Seth, it was, and I'll certainly circle back with the person who asked that and dig in a little bit more. But yeah, it was across participants. And then we did see, again, that even higher increase when we looked at that top performer population.
Good. Yeah, I know you could kind of dig through that data a little bit further. And we've got a question. Oh, somebody was paying attention on the capital rules. Yay. Should we look for smaller banks for warehouse lines rather than big banks to do the new capital rules? Great question. The answer is yes, no, and maybe, right? I think if you're large enough, and I tell people, so this is the free advice. There's other advice you get if you want me on a retainer. But I would say I would try to diversify your mix as best you can. Capital rules are increasing for everyone. That's 100 billion and greater. It's most impacted on those Cat 3 and Cat 4 banks. So if you've got a warehouse line with somebody that's in a category 1 or 2, their cost of capital is going up, but they're not being condensed on MSR side and some other factors. I would say that the best practices would be to try to distribute your warehouse lines across, if you could get to a Cat 1 or a Cat 2 bank, a couple Cat 3 and 4 banks, and a couple of the smaller shops, just to diversify your risk. Remember, those banks under 100 billion of total assets, while they're not impacted by the capital rules, if banks are exiting that space, they may get more business than they can handle due to the size of their institution. So in no ways am I saying you should only use the small. I would say try to diversify your risks across that whole set of them as best you can, and actively monitor with them, actively understand what they're looking for you from you, and do your due diligence to make sure that they can be good sort of counterparties in that sense. I think that is it for the questions. So a couple housekeeping reminders for folks. So I've got two public service announcements. One, you've probably received the email from Richie May that we are hosting an executive M&A, mergers and acquisition roundtable here in Denver, these offices, on September 21st. So if you're interested in attending, please reach out to info@richiemay.com. We're still looking for a few more participants, and that's going to be the executive level roundtable on M&A. And also, please complete the survey. We really do appreciate the feedback. We want to hear commentary like Seth should comb his hair, or, you know, less capital talk, more data from Molly. We get that one quite a bit. So, but we really do appreciate your feedback on these. We are trying to make these as timely as possible. I know capital isn't the most exciting conversation, but if you go anywhere, there's three things we're talking about: rates, the capital requirements, and kind of what their staffing levels are. So we tried to hit all three in this presentation to be timely, but please fill out the survey. And we do have one more question. So Molly, you're not off the hook just yet, but the question was, can you define fulfillment versus back office versus ops when you talked about the FTE costs? And that may be a technical definition that you need to get back to them on, but we did get that question in as well.
Yeah, definitely. Just give me 1 second here, and I can get back with, you know, more details here. But essentially, we're just separating out the different departments. So we're separating out sales, fulfillment roles. So that would be, you know, processing, underwriting, and then back office would be more of those corporate functions, and then ops overhead would be really non-department expenses.
Okay. And it looks like we did get a question on government lending was only up with firms with government tickets. We'll circle back with you on the government side and see if there's any more additional data we can give you on the government side. I would say this generically about the government side of the market. I think it's very specific as to where people are, but remember, in some cases, there has been some slowing in the housing market in certain areas. And so, you know, when you getting cash offers and you get a Ginnie Mae loan, Ginnie Mae offer, you're less likely to take the Ginnie. When you're only getting Ginnie Mae offers, you're more likely to take a Ginnie Mae offer. But we'll get back to you, the person that asked, on the Ginnie Mae volumes as well. I didn't want to not acknowledge that we got that question in, but we'll circle back with you with any additional information that we can provide. All right, with that, I have pretty much run out the clock, Gabby, as I usually do. So I think we're good. Hopefully people have gotten their CPE credits, filled out the survey. And again, if you're interested in that executive M&A roundtable that we're hosting here in Denver on September 21st, please reach out to info@richiemay.com.